Hello everyone, hope you guys are doing well. Well, I get a lot of requests from you guys about making a video and recommending a particular stock that one can buy for long term. So today's video is all about this, and the stock that I can recommend today is called as Apex Frozen. So what are the fundamental drivers of the company? What does the company actually do? What kind of upside one can expect in the stock price and risk factors and etc. and etc. All these questions will be answered in today's video. And if you're new to this channel, don't forget to like, share and subscribe to the channel. Your support keeps us growing and helps us improve the channel as well. So the first and the foremost thing that one need to understand is what kind of business does the company do before investing, because ultimately you would be investing your money in the business that the company is doing, and if the business is growing, then your stock price will increase, otherwise not. So let's start with it. So to briefly give you an introduction, the stock was purchased on 12th of May at 280 rupees per share. So this is the price at which we have started the video to recommend to reach the target price that will be coming up in the video. So Apex Frozen had begun its operation in 1995 and is one of the leading producers and exporters of processed shrimps. So it is basically into the field of producing and exporting shrimps. Starting as a processor of shrimp, the company has made continuous investments to now become an integrated player with strong presence across key areas and value chain. So what does it mean by key areas and value chain? Is because its product is now diversified rather than just focusing on the base products. So it has now base products, peeled products, specialty products and a ready to eat category as well, which did quite well during the COVID time. And it has a high margin, the segment also has a high margin to attach to it. So it is obviously very important for you to understand what kind of business does it do and what are the products that it caters to the market. So ready to eat is a high margin business, whereas other products also are its main part of the core business. So main activity of Apex Frozen is shrimp processing, where the capacity has increased from 15,000 million tons per annum, we'll call it MTPA, which was in 2019, to current capacity of 29,240 million tons per annum across its two processing plants. And it is ably supported by pre-processing facilities and cold storage capacity of 3,500 MTPA. And it is well backward integrated as well. So for backward integration, it has shrimp seed hatchery with a capacity of 1.2 to 1.4 billion SPF seeds across the three hatcheries. So it has a very well-rounded business, nicely backwardly integrated as well, to negate the effect of the input cost. It operates under one business segment overall, that is processing of shrimps and exporting. Whereas if we talk about it geographically, USA remains the main market. You can clearly see that 81% of the revenue for the company comes from the US market. That is, it is exporting to the US market, and 18% comes from the European market. So, and China remains at 1%. In the past 1 year, you can clearly see that the China growth versus FY21 has decreased. In FY21, it was 4% for China export. Now it has come down to 1%. Obviously, because of the COVID restrictions and a fear of spreading the disease through the shrimps consumption, which is coming from India. So the main market remains US and Europe, and this is going to be the driving factor for the company going ahead as well. So we need to focus on these markets. Now let us try to understand what the industry has been going through, because eventually a company works in the environment in which the entire industry is working. So if something is affecting the industry, obviously it is going to affect the company as well. So it is important for us to understand. So here is a pie chart that explains where the Indian companies or the Indian industry has been exporting, or in which region the Indian industry is exporting the shrimps. So US has been the major market with 46% share. This is based on the FY21 data, followed by China and other European countries. So China was obviously an important area in which region in which we used to export our shrimps production, but because of the COVID restrictions and this fear of spreading of COVID, this has come down significantly. But nonetheless, US and European countries remain a major market where the industry has been exporting its production. So overall, US is the main market for the industry, followed by China and European Union. India's shrimp production in fiscal year 2021 continued to grow on the back of increased area under cultivation and enhanced productivity. But shrimp exports, however, saw a fall of almost 10%, being exported in FY21 against FY20. This is obviously because of the COVID restrictions. And in FY21, global market was impacted heavily by the COVID restriction, China being the most impacted. You can clearly see in this graph, market-wise growth is shown for FY21. You can see that the China had a decline of roughly 30%, whereas other countries were also significant were affected, but not to a degree in which the Chinese region was affected. Okay, now comes the most important part of the video. What are the fundamental drivers based on which we are recommending a strong buy for Apex Frozen? So as you can see, here are the financial analysis. This is the financial analysis of the company, and it's not that great. 3 year sales growth, there is nothing. 5 year sales growth is also nothing. 3 years average EBIT margin is also not that great. So why am I recommending a buy for this? Because it has nothing to do with the sales growth or the margin growth in the past. This is all about the change that is expected to come in the coming years. So this is a turnaround story that is unfolding. This is expected to happen because the turnaround is expected to happen because of the increase in the capacity and operating leverage impact, because of the increase in capacity utilization that is going to happen going ahead, and because of the increase in demand from the US market and the change in mix. All about this coming in this short summary. So what are the drivers? Improving end market demand, especially in the US market. US market is the most important market because roughly 80% of its sales comes from there. So industry outlook has improved given the reopening of restaurants in export markets along with stable demand from retail customers. The demand in export market is picking up because of with the reopening of restaurants and catering segment, which had seen a sharp contraction during the lockdown period. Now that the lockdown has been lifted, the demand is coming back very steeply. Here is this is not something that I am saying it from my own assumptions. Here is what the company had said in its 9-month conference call. With regard to the US market specifically, both the food service sector and the retail sectors have opened up and the demand has been quite strong. So this is a very positive sign for the US market where the company exports majority of its product. So the market demand has come back strongly and the shipping lines, there is a comment about the shipping line disruption also, but that seems to be temporarily. What they mentioned about shipping line disruption is, so as such the demand is strong for now and we are having products which are completed and we are still waiting for certain equipment support from the shipping lines for specific destination which have not been served as there were regulatory served in the pre-pandemic times. So this is something, the shipping line disruption is something that we can expect going to be resolved in coming 6 months or so. That is the maximum time that I am stating, unless there is another wave that comes in the US market. So it's clear that the demand is coming back in the US market. So this was about units, that is number of units that are going to be consumed by the US market is going to increase. But the other aspect is also important for sales, that is the prices have been improving for the shrimps. Prices have been improving by more than 20% year on year from July 2021. So there is a steady increase in the prices. So this is a chart that I have updated for till April 2022. You can clearly see that in FY21 there was a steep decline. Roughly around 7% decline was there in financial year 2021. But from July 2021, the increase in prices have been 20%. More than 20%, and this has been a steady increase. Hence the end market demand as well as the prices are expected to increase the sales and eventually the margin of the company. There are two factors to sales, that is units, that number of units that you are selling, that is going to be driven by the opening up of the restaurants and the strong demand from the US market after the lockdown. And the second factor is obviously the price. So the prices of the commodity or the shrimps that are being exported has also seen a steep rise. So that is why overall sales is expected to grow in the coming year, and eventually because of the operating leverage impact, the margins are also going to be impacted positively. So another factor would be improving product mix. As we have already discussed in the product segment, that the ready-to-eat segment for Apex Frozen is a high margin business. Here is what they have said in the improving product mix, that is increase in sales proportion of high margin segment, that is the ready-to-eat segment versus its traditional business. This is something that we highlighted in our TCI case study as well, which turned out to be a multi-bagger stock. What they have said in the 9-month call is, most importantly for us, the share of our high volume ready-to-eat products increased to 20% in 9 months of financial year 2022 versus the 15% in FY 2021. So what happens if high margin business sales is increasing or sales proportion is increasing, is that your margins are going to increase. Hence, overall, a strong end demand, stabilized prices, and improving product mix are expected to increase the sales and margin for the company in the coming few years. Another driver for this is improving end market demand to become complemented by unused production capacity. So, in the past few years, the company has increased its production capacity from roughly 19,500 MTPA in FY19 to 29,240 by FY21, and the FY19 production capacity was 9,000 was owned and 6,000 was leased. So they were incurring a lease expenditure as well for that. But now they have a completely revamped and extended production capacity of 29,000 million tons per annum. Now, what is the issue is that the Apex will save on the diminished lease expenses that they were earlier incurring, and since this is the entire capacity is now owned and not on lease, but obviously the depreciation amortization is going to increase. Now the capacity utilization was merely at 45% of the current capacity, and with the increasing demand, this unutilized capacity is expected to come into the play and as gradually the capacity utilization increases for the company, then the sales are going to increase. So if there is an increase or surge in demand, the company has unutilized capacity of roughly 55% with them to cater to those needs. So Apex will be able to fully utilize the capacity in coming years because the demand is also increasing. So this will increase the sales, again the margin will increase, and eventually, because all the factors that we have discussed, one can expect, if the capacity utilization is increased from 45% to 90% in coming 2 to 3 years, then you can expect that the EPS could double in coming 3 years. It has a good debt to equity ratio. You can clearly see in our automated sheet, the snapshot that I've shared, the debt to equity is around 0.38, which is well below the mark of 1 that we have. Ideal debt to equity ratio is anything below 1. So it is at 0.38. Obviously, the above debt to equity analysis can be done automatically with the help of our automated sheet that we provide with our course. The link to that course is provided in the description. Another positive impact that the company is expected to have is because of the currency impact, that is the USD currency is strengthening. So the exporters from India to US are expected to benefit tremendously because of this. Since all its sales is in export, US accounts for 80% of sales. Recent depreciation of INR and strengthening of USD should impact the revenue positively, as the company would bill all its amount in USD and receive the amount in INR. Now let us discuss about the valuation of Apex Frozen. That is what kind of upside one can expect going ahead for the company stock price. Again, we would be using our automated sheet to compute the fair value of the share based on the 5 years average PE multiple. So, if you have a look at the snapshot that I am sharing from our automated sheet, you can clearly see at the bottom the 5 years average PE multiple is of roughly 16.98, and the last year's or the trailing 12-month EPS was roughly around 13.48. So, at using this multiple and the trailing 12-month EPS, the company doesn't seem to be undervalued. But we know that for sure that the company's EPS is expected to increase roughly around 2.5 times in coming 2 to 3 years because of the unutilized capacity that the company has and the increasing demand and the price. So you can expect the EPS forecasted EPS to be roughly around 33.7%. That is, I have taken 2.5 times of the trailing 12-month EPS, and based on that EPS, if you use our average PE multiple of 5 years, then you can clearly see that the fair value of the company in coming 2 to 3 years is expected to be around 570 rupees, which is a 100% upside from the current price of 280 per share. While it is currently showing at around that on 5 years average PE multiple of 16.98, the share on the current EPS of 13.48 is overvalued. That is, it is not undervalued. But the story is not based in the past. We have to analyze the future to understand what kind of upside is expected. But if you assume that the EPS will become 2.5 times of the current EPS of 13.48, with the previously discussed positives, that one can assume that based on the 5 years average PE multiple, that within 2 years the price of the share will increase by more than 100% to roughly around 570 per share. So you can expect that the share price is going to double in coming 2 years. Now let us talk about the recent developments and the points that you need to look forward to when you have invested in the shares. So recently they have been talking about high freight costs in the conference call. The reefer containers that we use for transporting our finished products to our customers continue to be challenged for the industry, and the freight costs have been at the highest point in the last quarter. So this is an important factor that you need to understand, that the company is being affected by the high freight cost. But I believe that this is a short-term headwind that the company is facing, and this issue is expected to resolve in upcoming 1 or 2 quarters. Change in the regional mix. So the company is now trying to increase its focus on the European market as well, not overly relying on only one market, that is the US market. Now they are expected to increase the share from roughly 14-15% to 25% in the upcoming years. This is not to say that they are not going to focus on the US market. US market's demand is tremendous and the sales are expected to increase there as well. But they want to increase the share in the other market as well. Increasing the capacity for high margin products. This is something that they are focusing on. They have an expansion plan of ready to eat segment from 5,000 MTPA to 10,000 MTPA. So overall capacity is expected to increase from 29,000 MTPA currently that we have discussed to 34,000 MTPA from October 2022. So they want to expand in the ready to eat segment because they want to expand their margins as well, because it is a high margin business. So overall this is also positive. The company is expecting a strong demand in coming time. So there is an expansion plan in place to increase the production capacity of ready to eat product, which is also a high margin business. So better products mix will be good for the margins as well. Overall, the company seems to be moving in the right direction because they have a strong demand coming from the US market. They want to expand in the other European countries as well, and they are expanding in the ready to eat segment as well. Now, what are the risk factors for the companies is something that we need to understand. When you have invested in Apex Frozen, you need to keep a track on at least this news that are coming. There could be a demand slowdown, something that you need to understand if there is demand slowdown in the key markets. Disease-related slowdown could also be there if there is another wave of COVID coming ahead, because shrimps are highly susceptible to outbreak of any disease. This is something that happened in 2015 as well, and 2021 obviously. Volatile prices is also something that you need to take into consideration. Exchange rate fluctuations are going to impact its margin and sales. But for now, it is positive for Indian companies who are exporting to the US market, because Indian currency has been depreciating versus the USD currency. Hopefully you found this video helpful in analyzing the stock, what kind of analysis goes into the stock. I've been into the field of equity research since 2014, and hope you guys understand what are the factors that we take into consideration, what are the driving demand factors, what could be the potential upside for the stock. Everything I tried to cover in this video. Don't forget to check out our course at www.sidsacademy.com. Link is provided in the description. A lot of research work has gone into making this video, so don't forget to like, share and subscribe. Your support is always very encouraging for us to keep the channel moving ahead in the right direction. Thank you.